Hi everyone, it's Kylie. Welcome back or welcome to my channel, Investing Basics, where I'm covering the topics I have deemed crucial to understand in order to develop a strong basic financial literacy. Today's topic is going to be time in versus timing, and specifically focusing on why inflation matters. So I'd like to start off with a brief review of my last video, which is titled Investing Early, The Power of Compound Interest, where I talked about why it's important to try to invest early and leave your money in the market for as long as possible in order to allow your money to continue compounding on itself so you get a large return. If you'd like a little bit more information on how compound interest works, please feel free to go check out my other video, as I was saying. But today, we are also going to talk about why leaving your money in the market for as long as possible is important, but we're not going to take it through the angle of compound interest, but instead, inflation. So that is today's topic, inflation. And I'd like to start off with what exactly is inflation. In simple terms, inflation is the value of money decreasing over time. In other words, a good example I like to think about is $10. I can buy a pretty nice t-shirt today for $10, but 30, 40, 50 years in the future, that exact same t-shirt would cost more than $10. I would need to spend more money in order to buy that same t-shirt that I bought today with $10. And a really, really good activity you can do is to talk to parents, grandparents, or really anybody older family friends, and ask them how much a car, a house, milk, stamps cost when they were children, and compare it to the price of those items today. So you can really compare and contrast and see how inflation has impacted the prices of certain items. And I'd also like to touch on how inflation impacts the stock market. The stock market, if you look at the entire history of the stock market, has an increasing upwards trend, and that is mainly due to inflation. As prices rise, as caused by inflation, as I just discussed, the stock market will also rise just because the businesses will make more money and get larger returns just because of the increased prices, and thus the market will rise. So inflation and the market go hand in hand. And this is why it's important to invest your money, because it allows you to keep up with inflation. If you put $100 and you buried it in your lawn today and you took it out 100 years later, yes, that money would still be $100. It would be completely safe. There was no way you could have lost that $100 and it wouldn't have decreased. However, the value of that $100 would have decreased. It wouldn't buy the same thing 100 years later that it does today, which is why you should try to get involved in the market. Now, to talk about why inflation is important for investing, it gives rise to one of the biggest concepts in investing: time in, not timing. So, a lot of times people try to time the market perfectly. They get greedy and they put in their money when the market is on the rise. And then when the market dips again, they pull out their money out of fear. That's actually exactly the opposite of what you should do. You need to avoid fear and greed when you're investing and try to invest with your head and not your stomach. When the market goes up, basically the prices of stocks go up too. So when you put in that money let's say you put in $10 and then the market goes down again and it goes down to $8 and you pull out that money, you just lost some. Have you ever been on a highway and you're in a lane and it seems like all of the other lanes are going faster, so you finally decide to switch your lane, and then as soon as you do, the lane you were just in starts going faster? That's exactly what it's like trying to time the market perfectly. You invest your money when the market's going up a little bit, and then it goes back down again. The market is supposed to be something that you look at over a long-term timeline, and a lot of people look at it as a short-term investment and they try to time it perfectly, the small daily increases and decreases of the market. But that's not how you should look at it. You should look at investing over a long-term period of time when you have an appropriate timeline to not stress out over the small daily increases and decreases of the market that are so often over exploded by the stock page of a newspaper, for example. You've probably seen the headlines, "Stock market soars, stock market plunges." I wouldn't get in an elevator if the button said soar and plunge, and honestly, neither should you. But a lot of times, those titles are over exaggerated. The stock market does have daily increases and decreases, and that's okay because you are trying to invest for the long term to keep up with inflation. So, thank you so much for watching this video. I hope it was clear. If not, as always, please feel free to email me at womaninvesting1@gmail.com or comment down below any questions you have, and I'll try my best to answer. But thank you so much for watching, and please feel free to check out my other videos. Bye.